Welcome back to AWM News Update. I'm Zoha Ahmed and I'm joined by my co-presenter Dariush Yazani.
Let's jump in, Zoha. In this month's update, we will be taking a look at Brexit and how it's affecting asset managers, job cuts across multiple companies, and we will also take a look at PwC's recently published Asia Awakening report.
Sounds great, Dariush. Why don't you take us through the markets?
Sure, Zoha. Recently, the IMF cut its world growth forecast for 2019. It cited Brexit and the slowing Chinese economy as risk factors contributing to the revision. The US also flagged these concerns and has put interest rate hikes on hold for 2019. During his speech, Powell noted that the Fed anticipates that the global economy is likely to see a slower growth, and he therefore preached patience. While on the subject of interest rate hikes, the ECB is set to keep rates at zero, citing rising market volatility. Notably, when looking at European economies, Italy fell into a technical recession in early 2019. In the markets, main stock indices around the world reacted positively to the central bank positions. The S&P 500 posted its best January since 1987, growing by 7.87%. 10-year US bond yields decreased to 2.71%, down from 2.83% the previous month. Euro Stoxx 50 posted a 5.26% growth, and Euro 19 10-year bond yields decreased minimally from end 2018. Let's head back to Zoha and see what's going on around the globe.
Thanks, Dariush. A common trend we have seen recently are job cuts, with BlackRock cutting roughly 500 jobs, or 3% of its global workforce, as a part of a revamp towards higher growth areas. State Street cut 1,500 jobs in order to automate more operations, with the cuts including 15% in senior management roles. They expect to reduce costs in the challenging market.
In Hong Kong, Value Partners and Vanguard both confirmed job cuts. Value Partners cut its headcount up to 10%, dismissing only a small number of staff in an effort to optimize resources. Vanguard cut a fifth of its Hong Kong workforce in a move to reallocate resources to build a stronger Chinese presence, restructuring its Asian leadership to position the firm for expansion in the region.
For me, it's very clear that asset managers are making every effort to streamline their operations in order to optimize and reduce costs. When we look at this, along with IMF's reevaluation of forecasts, we wonder what's in store for the AWM industry.
Indeed, Zoha, if you look at it, and as you mentioned, the forecasts of IMF, which have been revised downwards, I think asset managers are starting to prepare for this event. And I think they need to concentrate on optimizing and concentrating on creating efficiencies to be prepared for this downturn.
Right. Now, taking a look at Brexit, we see a lot of companies are planning relocations as the March 29 deadline approaches. In the event of a no-deal Brexit, BlackRock and Goldman Sachs plan to temporarily relocate portfolio managers to the US, and again move them back to mainland Europe once a regulatory framework has been set up between the UK and the EU. Other firms have announced their intentions to relocate operations to Luxembourg and Ireland. According to a PwC report released mid-2018, 39% of surveyed asset managers are planning to relocate functions to Ireland. Several asset managers have already confirmed the movement of operations to Dublin, including Legg Mason, First State, and Baring Asset Management.
Luxembourg authorities have already granted 80 new licenses for fund managers, and 47 financial firms confirmed Luxembourg as their location of choice. We have also seen, Zoha, that among those, M&G, Standard Life Aberdeen have moved substantial operations to Luxembourg.
Yes, this is a fairly uncertain time for asset managers, but it's definitely interesting. Now, we are joined by PwC's AWM Brexit leader, Rob Miller, to continue this discussion. Hi, Rob. Thank you for taking the time to chat to us. I think we'll start with perhaps the most pertinent question. The UK market has seen some substantially volatility since the announcement. What, based on the various agreements that could be made, is the outlook for the British AWM industry?
Yeah, I mean, obviously the industry is having to grapple with the ramifications of Brexit, and I guess there are various things that people are concerned about. One is continued access to the European market in terms of being able to manage European funds and being able to market to European investors. Those are the two key things people have been concerned about, and therefore they've been thinking about the need to have an onshore European presence to deal with that. Conversely, there are some other themes emerging from the Brexit agenda in terms of what will be the appetite for UK investors for non-UK products. And we have seen some anecdotal evidence in the market that UK investors may be turning towards UK products rather than offshore products. And that partly that may be because some of the regimes that have been announced by the FCA are temporary and people are concerned about the long-term future of some of those regimes. But there may be, we may actually see an uptick in both European and non-UK managers wanting to open manager operations in the UK, but also launch UK funds for the UK market. So the issues are both outbound and inbound.
And what are some of the challenges that our firms are facing because of Brexit?
Yeah, I think the challenge for a lot of clients has been to think beyond Brexit. I think initially a lot of people saw Brexit as a legal and a regulatory issue. I mean, let's be clear, there is no version of Brexit that works for the asset management industry. For all versions of Brexit, we have something which is less efficient than passporting. So you have to engage with this is an impact on your business. But I think people generally saw that as legally, which country should I be in, what structure should I use, and regulatory, what permissions do I need? Whereas I think actually, once you get beyond that initial thinking, what we've been trying to get clients to focus on, you are really trying to stand up now your European future operating business. This is the vehicle through which you'll manage, maybe numerous European products in the future, and through which you'll market and reach out to your European investor base. So it needs to be a bona fide commercial, robust business with substance and operations and governance and controls. And I think it's that stage of moving beyond the very initial legal regulatory analysis to appreciating the fundamental operating model change that Brexit will be, and actually having a future European operating business beyond Brexit. I think it's that journey has been difficult for a lot of clients, not because they don't appreciate it, they didn't just start from that point. And I think moving down that journey, building out that substance, engaging with the local regulators and thinking about how it changes your overall operating model has been one of the bigger challenges.
Some very important points made there by Rob. And I think, if UK firms move out of UK and relocate to Luxembourg and places like Ireland, I don't think so that they will relocate back even if EU and UK should reach an agreement.
Of course, absolutely, as they have spent a lot of time and money on relocating staff and operations already. For the future success of the industry, it is vital that they reach an agreement to stop the continuing uncertainty and regain composure amongst global asset managers. What has been going on in actives industry lately, Dariush?
The topic of fee pressure have been fairly pronounced recently. ESMA released a report in the beginning of 2019 that dives deeply into the topic, highlighting that costs represented a significant drain on retail investors' returns.
That's to be expected, though. With their large mandates, institutional investors have considerably more bargaining power with asset managers. What was interesting to note was that the overall equity products have, according to ESMA, consistently underperformed against their passive counterparts, all while charging significantly higher fees.
We dived into this in our Pressure on Profitability report, where you look at active equity products in 2017, their management fees stood at around 0.7% compared to passives at 0.15%. That's a significant difference. Naturally, active managers argue that there are a number of benefits such as downside protection and stock picking that makes actives better. However, I think when you look at the critics of active management, they point out to the fact that over the long run, actives won't be able to outperform passives.
Just look at the market volatility we saw late 2018. Passives fell, yes, but so did many actives. Naturally, some managed to stay ahead of the market, but I think those were few and far between. On this note, It's great to have Owen Alexander, PwC's Global AWM leader, join us. Owen, thank you for being here. Against a backdrop of volatility seen in the markets in end 2018, and noting the fact that most of the losses had already been made up by mid to end January, what do you believe the industry will see in 2019?
So most of the economists globally are aligned in their view in the markets that we're entering into a period of slower growth as we enter the late stages of this inflationary and expansionary cycle. We're also seeing increased volatility in the markets. So while asset allocators continue to invest and believe in the growth story for 2019, we're seeing added amounts of protection being built into portfolios as well. What does that mean for our industry? Well, I think we're going to continue to see fee pressures. We've predicted that by 2025, fees will have fallen another 20%, and that's putting significant pressure on margins as costs are not reducing in any form. So a continued focus on the cost agenda from managers, and we're seeing scale play an increasingly bigger role. So some fairly large managers coming together and consolidating to create even greater scale for themselves. In an industry that's under huge cost pressure, scale can help be part of the solution. But of course, we believe that there's a very bright future for niche players and also mid-sized managers who can really differentiate themselves going forward.
And Owen, how do you believe asset managers should react to the changes they will see?
So there are 4 areas where we think managers should focus. They should focus on the customer, focus on their strategic positioning, focus on technology, and finally, but not last, talent. First of all, customer centricity, really making sure that they're articulating value for money for the investors, looking at their pricing structures and being amenable and responsive to client demands for reduced fees, but perhaps in more innovative ways, and looking at the new fee models that they might be able to agree with investors going forward, as well as looking at the whole customer experience in terms of dealing with them. Secondly, from a strategic positioning perspective, managers need to be crystal clear on what it is their differentiating factors are, where do they want to grow, what are they strong at, potentially entering into a JV or some sort of alliance or partnership in areas where they're not going to invest themselves but want to expand. So really focusing on where they want to grow and how they're going to do it, who are the target investors. Thirdly, technology, and making sure that they have an integrated technology platform is absolutely key. Also making sure that they can manage data and use data to best effect, both the front office from a portfolio management perspective, but right through the middle and back office, making sure they're feeding their organization with smarter thinking and smarter environment using the data that they have. And then last but not least is talent. Fighting the battle for talent in a very crowded space in terms of looking for data skills and technology skills, making sure that asset and wealth management managers are fighting that battle for talent, but also in looking at that talent, thinking about the productivity of the talent pool. So are you really getting maximum efficiency and maximum productivity from the people that you have working in your organization? Have you embedded an agile mindset throughout the organization, not just in the IT department? Making sure you're focused on the change function and really thinking about constantly upskilling your people. It could be in digital or technology skills, data and analytics, whatever it might be. We know now we're entering an era where people are going to constantly need to be upskilled.
I think Owen makes some very interesting points there. I think it is important that active managers over the coming years demonstrate the value for money to their investors. However, if actives still keep on underperforming while asking for higher fees, we will see the acceleration in the move from actives towards passives.
I think we will still see the top range of active managers outperform, and investors will become a lot pickier about ensuring that they are going to those managers who are consistently beating the market. But let's move on to passives.
There's been a lot of news on the ETF front this past month, Zoa.
Yeah.
Let's talk about Vanguard first. They launched a range of equity and fixed income ETFs in Italy early this year. LGIM also set up an Italian office in order to roll out a range of ETFs and UCITS to Italian investors.
JP Morgan had some of the best-selling newly launched funds in 2018 and has increased its efforts to regain assets lost to BlackRock and Vanguard over the past decade. Investors pumped $16.8 billion into JP Morgan's ETFs, up from $1.6 billion in 2017.
It will be interesting to see them grow the coming year. What do we have on alternatives, Zoa?
Market volatility and poor performance hit the alternatives market hard in 2018, Dariush, resulting in a decline in hedge funds AUM.
So, however, the hedge fund industry was able to beat the S&P 500 index for the first time in a decade. Although the industry overall lost $64.2 billion, we saw the top 20 hedge fund managers manage to outperform, collectively increasing assets by $23.2 billion. This is largely in line with many people's understanding of the hedge fund market, in that a select few seem to outperform the market drastically, while others lag behind.
Did you hear about Bridgewater's Pure Alpha Fund? It managed to outperform both its benchmark and its competitors in 2018. The fund returned 14.6% net of fees, while the average fund underperformed substantially, losing 2% in 2018. It'll be interesting to see what 2019 holds for hedge funds. Now, Dariush, let's examine research reports.
January saw the release of the ESMA annual statistical report, which looked at the performance and costs of retail investments products in the EU. The report dives into costs versus performance by asset class, stating that costs across asset classes are less variable for retail than institutional investors.
The Asian Awakening report by PwC this month looked at how the APAC asset and wealth management industry is expected to be the center of global AUM growth in the coming years. APAC assets under management is set to grow faster than any other region globally. Expectations are that it will rise from $15.1 trillion in 2017 to $29.6 trillion in 2025.
I believe this growth will likely be uneven in the more developed APAC markets and fastest in developing markets. It looked to the what-ifs of the next few years, so managers have an idea of what the possible implications could be, and so they can prepare and plan for possible scenarios. That's all the time we have for this month.
Thanks for watching, and don't forget to like, subscribe, and share.